Lemonade just made a big deal and how they're going to acquire future customers. We're going to cover that today and also cover why we own Lemonade and the things that are working against them and the things that are in their favor. I'm Bradford Ferguson. I'm here with Matt Smith, and we're from rebellionaire.com. And Matt, maybe you could go ahead and talk a little bit about Lemonade.
Yeah, so Lemonade's a new name for our clients here. It's a company that has really been talking about AI and building their model around AI for the last, 7, 8 years before AI was even the kind of hot topic that it is right now. And really what they saw when they were looking at the insurance space is the product of insurance itself is incredibly prone to be to make use of AI. So what
Hmm.
is insurance? At its heart, it's making use of data to have accurate pricing. And
Hmm.
so it used to be the case hundreds of years ago that the very best data scientists in the world all worked for insurance companies. But lately, all the best data scientists have gone to the tech companies to work for, Google and Microsoft and all these other, really advanced tech companies. So what they saw is it makes a whole lot of sense to use artificial intelligence to get a whole bunch of kind of firsthand primary data and have automation essentially make use of that data
Hmm.
to have more accurate pricing on a very kind of micro level specific to each individual customers. So when you think about the way that insurance is done in most of the legacy companies, it's, oh, what's your zip code, what's your marital status, and these kind of heuristics are proxies for risk, but they're not really individual specific risks. So instead, if you have your exact address and if you have your exact age, all these other risk factors that you can aggregate together and that you can track over time, you can improve your artificial intelligence model, and you should have,
Hmm.
in theory anyways, better pricing over time. The other thing that they've done, which is I think really interesting, is that they're trying to go away from the entire agent-based business model where you have physical agents, brick and mortar stores, and you've
Hmm.
got to kind of spread across the whole country with very high fixed costs in order to service all of your customers. I think for the younger generation, myself included, and especially the kind of younger cohort that's just starting, who's their primary audience or target market right now, people really prefer to just be able to have the convenience of doing this stuff online. And so they
Yeah.
have a really great user interface where you can get a quote in a matter of seconds. It's explained in kind of plain English with very kind of clear explanations of what your coverage includes and doesn't, and what the different trade-offs are between your deductibles and how that impacts your premium. So they've got a really great user experience. They're starting off with the younger users, like I said, so people who are just starting off on their kind
Hmm.
of professional career. They need maybe renter's insurance, maybe they've got a pet and they start with that. But the idea is, I think anybody who's 30 years old or older has kind of seen what they were spending on insurance when they were just starting out, 20,
Hmm.
25 years old, something like that, is just a fraction of what they're spending by the time they're much older and maybe are married, own a house, have some kids, and you've got a lot
Hmm.
more assets that need insurance to be protecting. So they're at this interesting uh, spot, I think, where they've got a whole bunch of tailwinds. You've got, their artificial intelligence is like, that's like the hot topic right now, and that in fact, they've just proven a lot of the efficacy of their pricing models, as shown by the fact that they've been able to kind of steadily improve the loss ratio quarter after quarter for the last at least 4 quarters or so, and it's been a longer trend after that. So
And
so
what,
they're
let me explain briefly loss ratio. So, like, that means for every dollar they take in, how many dollars do they have to pay out on a policy?
Yeah, exactly. So when they're first starting out any new policy, they don't have a whole lot of good data. They don't have a history that they can kind of fall back on. So obviously you're going to have worse loss ratios when you're just starting out for a new product. But
Hmm.
they really have improved that quite substantially, and they have a trajectory to get down to kind of industry leading or at least industry average loss ratios, which frankly they're not there yet. So there is some work to go. But
Yeah,
so then on.
and if you get to the lowest cost ratios and just having the lower fixed costs, then you're way ahead of the game from there.
Yeah, I mean that's one of the things, almost the thing that is most attractive about this business model is, okay, they've built out this entire infrastructure. A lot of people have, like, a lot of insurance companies have kind of dipped their toe into using AI for some aspect of their business model, but they've
Hmm.
built this one fully integrated piece of software that does pricing, it does payouts, it does new customer engagement, and they're continuing to feed this feedback loop all the time. And so they have built in-house just an incredible backbone infrastructure
Hmm.
that is at its heart built for scale.
Yeah.
So you can potentially 10x your premium that you're generating, but you're not going to be nearly increasing by 10x the amount of overhead that you need to support that, because you're not, you're just building you're scaling up your software as opposed to opening a bunch of new offices nationwide. So if they can continue to grow their customers, so you've got customer count increasing, and then
Hmm.
those customers are aging up, and they're also bundling. So that's another one of the really interesting things, is they have not offered all of their products in most states. And their average premium right now is in the $350 range, which,
Hmm.
if you think
Per
about
year,
what's
right?
per year,
Hmm.
what somebody spends on car insurance, like that product alone is significantly higher than $350 per year on average.
Hmm.
So as they start offering that in all 50 states, and not to mention their home products, their home insurance, and other products, you start bundling those together, the premium per customer is also very likely to increase.
Yeah.
So you've got like a double exponential of increasing customers and increasing premium per customer, which has like
Hmm.
this duplicative or multiplicative effect on their premium generation potential as you kind of extrapolate out over time.
Yeah.
And then the massive operating leverage that comes with having a very low kind of fixed cost base, which right now is negative. So a lot of the short sellers out there, or people who just don't think the stock is a good buy, rightly point out the fact that they're burning money right now, and they're frankly many years away, probably by the company's own estimates, about 3 years away from reaching profitability. So they've got some execution to do, and frankly a little bit of work to prove that their model scales. But I think if
Hmm.
they do, and they reach that inflection point where they suddenly turn profitable, like they're not just going to start there and like maybe grow profits 20% a year. It'll be like almost a hockey stick with how quickly this inflects.
Yeah.
So it's a really exciting opportunity that they're pursuing right now.
So you have more customers, you have higher premiums per customer, and then getting those loss ratios down over time is going to lower your costs, like and increase this area above the curve, which is your profits. So as they're able to do that, we see these three tailwinds for them. Um, One of the things they're waiting on is increasing premiums. They have to get state regulator approval to raise premiums on car insurance. We've had a lot of inflation, other things going on, and they have a lot of requests to raise premiums. You know, in pending
Mhm.
status. So that should also help them over time too.
Yeah, it should. And in fact, they were giving a little bit more commentary on the fact that they're just starting to see some of those kind of approvals come in. And this is
Hmm.
something that's been a drag industry wide, especially in California, where they do have a lot of customers. This has just been, the regulators have been, I think, intentionally dragging their feet a little bit in order to kind of provide some relief, quote unquote, for the residents within the state. But then that just makes the entire insurance book there kind of unprofitable. So you had,
Hmm.
that kind of dynamic going on to, different extents in different states. And Lemonade is also international as well. So they've got existing relationships with a lot of different regulators. But insurance is a capital intensive business. And
Hmm.
so that is one, potentially limiting factor is, and they actually intentionally dialed back their spending on marketing this year, because one, it's just a higher interest rate environment, so their own
Hmm.
kind of cost of capital has increased, which makes the hurdle rate for new projects look a little bit different, or worse than when we were in this zero interest rate environment. But then you also have to. There's a good amount of their capital that's tied up just to essentially backstop the premiums that they have outstanding.
Yeah. So let me quickly share my screen and we'll talk about this news. So one of our biggest investors in Lemonade is making a financial deal where they are going to finance a large portion of the customer acquisition costs, or advertising, and the amount that goes into um, acquiring a customer. And these people are going to get a payout over time. Um, to get these customers for Lemonade. So it'd be like a virtual agent, but they're going to collect a portion of the revenue and are going to get a fixed payback. And we think that as long as Lemonade can improve their loss ratios and continue to grow over time and keep these customers longer than just 3 years, and already their turnover is 20%. So typically a customer is going to they'll last about 5 years. We think this is a really good deal for Lemonade. Matt, do you want to talk a little more about this?
Yeah, it's it is kind of interesting. So thinking again about the legacy insurance business and how they do this, so they will essentially leverage these agents that we talked about, the insurance agents, to generate new business. So those insurance agents will kind of take the risk of spending some money on marketing and everything like that, and the insurance company benefits because they get the premium for the lifetime of that customer. Well, the way the deals work right now in the industry is that that's an evergreen kind of cut of the profits or of the premiums that agent will get. So if you've got a 75% loss ratio, that means 25% of the premium the company gets to keep to kind of cover all their costs. Then you might be paying out, I don't know what the exact numbers might be, but maybe half of that goes to the insurance agent who brought that customer in perpetuity, which is just like a permanent drag on your profits. So with this deal, I've seen some criticism of this deal that, it's just basically you're providing like venture debt, or it's a debt-like kind of financial instrument that's at like a 16% return. So it's like a very high interest rate cost that they're actually providing here. But I think that the flip side of that is, if you think about what you're replacing, so you're getting new customers in, you are paying like a 16% return, but it's for 2 years, and then that cost is out the door. Then you've got the benefit on the entire back end of these customers for as long as they stick with the company. You get that gross margin at rates higher than the incumbents can possibly receive. So it's just another one of these metrics where, if the company can actually pull this off, the return profile is like absolutely nutty. They actually had a blog post accompanying this series of tweets from Daniel Schreiber, where they said that based on their own internal modeling, this deal provides a 90% IRR, which sounds like, okay, that's too good to be true. That can't be right. But I did some math kind of back testing, and it's like, with some somewhat reasonable assumptions, you can very easily get to that 90% IRR figure. They also say they'll have an extra $100 million of cash at the end of 2026. So if you think about the importance of them having some cash cushion in order to kind of bridge the gap to profitability and not need to go out and do an equity raise when the stock price is down, that's like, there's a lot of benefits. So there certainly is some execution risk. If their loss ratios don't improve, or if they just don't get their business turned around and trending in the right direction, it could go against them. But if they really start clicking on all cylinders the way that management is essentially projecting that they are, I mean, the return profile is going to be absolutely nutty on this, on this one particular synthetic agents business. But I think also it'll translate to the rest of the business as well, and hopefully the stock.
Yeah, so it looks like I think our analysis was that it would be a cash drain early on, and that starting in about year 2, it's going to be additive to profits. Is that right?
Yeah, so I mean, they're essentially increasing their spending, and there is, you lose a little bit up in the very first year when you add that new customer, because your loss ratios tend to be higher when you've got the first year of any new kind of customer cohort, and then also you're paying the synthetic agent, that General Catalyst, a pretty hefty fee. But then by year 2, you start to recoup that. And then in year 3, which is 2026, it starts to become cumulatively additive. So what Daniel was saying in the post is that they're going to have an incremental $100 million of cash on their own internal models by 2026, which is the year that they're going to be turning profitable. So it's essentially a way for them to be capital light while essentially doubling their investment in customer acquisitions. So they're going to do that in a way that's capital light, but it still is going to be an incremental drag relative in the very short term relative to if they hadn't done this deal.
Yeah.
So it's kind of interesting because I think you might see some potentially worsening, spend, or margins might get a little bit worse in the next, 12 months or so, at least, assuming nothing else changes with the rest of the business, this kind of hurts. But then on the back end, the benefits are so outrageous that it's like obviously going to be more than worth it.
Yeah, what struck me about Lemonade is they're pretty responsible on the rate that they grow. They're not growth at all costs. They seem to be cost conscious about their growth, and not just trying to YOLO into a high level of revenues. So we thought this development was fairly positive. Definitely, there's a good return for the financiers, but there's a good return for Lemonade. If they can get their loss ratios down on with their home insurance and not have as many catastrophic hits like they did in, I think Texas was one area, and they're learning how to avoid some of that, moving forward. And if they can price automobile insurance better and get those rate increases, then this could be even better than we're modeling as a base case. Any final thoughts, Matt?
Yeah, I mean, maybe just one final thought we hadn't touched on is that the customer lifetime value, according to Lemonade's own internal estimates, which is for however long you have a new customer, what's like the sum total of all the gross margin that you're going to receive from them. That number is 3 times what it costs them to acquire a new customer. So just based on that math, if money was no object, they should be spending like every spare penny they have on acquiring new customers, because the net present value, when you run that out, is so drastically high. So as long as there's not some fundamental flaw with their models and with their numbers, the way that they're looking at, this is going to be an incredibly value creating arrangement that they have. And frankly, the rest of their business is going to be incredibly value creating as well. It's just a matter of how long it takes for that to play out and kind of show up in their financials and show up in the stock price. So I'm excited to be in this in the long haul for our clients here. None of this is financial advice. We are financial advisors, but this is just our opinions. But we really love the risk reward potential, especially when you look at a stock that's trading just at a very slight premium to their cash balance. And they've got all these tremendous long-term catalysts to really change the way that insurance is made and sold, and the profit potential. So very excited to be in the stock, and curious to see how the story pans out.
Yeah, June 30th, 2023. Clients and employees of Halter Ferguson Financial hold a position in Lemonade stock and or options. Yep. So we'll look to end it there. I'm wearing this goofy shirt because it's a Rebellionaire logo. I thought it'd be fun. I'm going to be doing some rock climbing later today and need a nice lightweight shirt to wear. So that's why I'm super casual today. Anyhow, Matt, thank you for your analysis and looking at this and modeling it very quickly, helping us understand this better.
Thanks a lot, everyone, for watching.
Yep. Bye for now.